Yeah. Okay, so we are live.
We are live. Let's see. Let me update. Come on. Can't see anything.
You're on Facebook?
Mm-hmm.
My Facebook page?
Yours or
Find Nest, either one. Should both be alive on there.
I'm on Find Nest. I don't see it. Let's see. Let me go to Kelly. What's up, everybody? Welcome in. Oh, here we go.
Got it?
Mm-hmm.
All right, we're ready to start because we're live.
Yeah.
All right, cool. So welcome, everyone. This evening we are going to be, hang on, I need to hit the record button. We are here. I'm Kelly Martinez. I own Finest Realty Group, Finest Interiors, and Finest Investments. And I have Michael Martinez with me. We are both Martinezes of no relation and no hablo español. So we are here just to talk about the market and give everybody a quick update. And Michael is with Embrace Home Loans. And so he's going to be telling us all about kind of the products that they have in order to help buyers in this crazy market where the interest rates just seem to keep on climbing. So just a quick overview of the market first. I'm going to be specifically talking about Northern Virginia because that is what I know. And actually you can get updated on our website every month. We actually post our newsletter and it has the metrics for several of the markets in our area. But if you go to our website at finestrealty.com and then you go under newsletter, you can basically click on the month and you'll see our newsletter, and it has a great overview of what's happening, but then also the market statistics for several different counties, including Fairfax, Prince William, Loudoun, Montgomery, Prince George's. So those are all listed there for you, and you can get an idea of what is happening in each of those segments because the market is very specific as far as micro markets are concerned. You know, a lot of the news and the media that we're hearing is very scary, but in reality, a lot of that is nationwide statistics. And because of our great job market due to the government and all that stuff, we are a little bit more insular than some of the other regions in this country. And so we're lucky enough to really be in still a pretty great market for both sellers and buyers. But I will tell you that it's definitely slowing down. And that is what our market statistics tell us when we look at the July versus August metrics. The average sold price in Fairfax County actually went down 7%, and the days on market increased by 4%. So, you know, the price, though, is still up 11% year over year. So that's why you should pay attention to these statistics, especially if you're looking to buy or sell in the coming months. It's really a great place to get a very good, quick, easy read on what's happening in our market. So feel free to take a look at that newsletter whenever you have a chance. But again, we usually post it by the second Friday of the month, and it has updated metrics for the previous month. So I am going to go ahead and let Michael kind of take over and tell us where we are with the current interest rates and what's going on.
Appreciate that, Kelly. Thank you very much. Excuse me. That was great to go over. I actually didn't know that. About 7% down and 4 days up. So that's a very good newsletter. I'll definitely be checking that out. Really quick, I know everybody's concerned about the interest rates right now. I'm not here to tell you something that's going to be that they're dropping tomorrow or that they're going to go back to the twos. But what we can offer you is a little bit more education into how to approach these rates in this market to where you can still win and be able to look at the silver lining, if you will. So we're going to go through a couple scenarios that kind of played out in basically what a conventional loan would look like, and a new product that we have called Prime Plus that we're offering at Embrace exclusively, and kind of how that can help you tackle the markets and today's rates. So I think Kelly's going to share a slide and we can kind of jump into that right away.
I'm trying to.
Okay, so I can keep talking. So,
yeah, keep talking about something else.
On the first scenario, basically, and I'll just start going over this a little bit. Even without the slide, you guys can kind of get the gist of this. So on a $500K purchase, I priced this out earlier today, just before market closed. on a 500K purchase, a regular conventional loan, we are at just about a 6.375 rate right now. That's with selling with a point. As you will find, most lenders right now are going to be selling with a point. So today we're just going to consider all the rates that I'm mentioning with a point as par. So 6.375 on a conventional loan, 500K purchase with 10% down. So that's a $450,000 loan. With that being said, that's huge, right? Because we were at, mid to high twos for a little while there. And even last year, when people were starting to get concerned, when we were in the threes and high threes and then even fours, a lot of you are getting concerned and maybe pulling back from the market. This example will hopefully show you a little bit about where we are today and kind of how to take advantage of that. So thank you for pulling that up, Kelly. So this just kind of gives you a price breakdown. As I said, basically in rate comparison on a 500K purchase with 10% down, these are both 10% down and a 700 FICO score. The difference in rate is over a full percent difference in the Prime Plus product that we're able to offer right now. The biggest thing coming to this is, Kelly, if you would just scroll down a little bit. Here about this. It's just a little lag. Over go.
Here?
Yep, perfect. So as you guys can see right here, the difference in monthly, what that equates to, that 1% on a 450K loan is $322 a month, and that's an interest only. Everything's going to stay the same on the home price, right? You're still going to get the same insurance quote. The taxes are going to stay the same, at least for 1 year, right? And that's the one thing that will change every year, is we're just going to constantly keep updating those taxes. But $322 a month in interest alone is what that product can save you. Along with that, if you want to scroll down just a little bit, just so we can get a bigger picture idea here, it's going to show you over a full 7 years, the difference in principal and interest paid. So the difference in principal that you have into the house, principal paid is $52,000 with the Prime Plus versus a conventional loan. You're only paying $43,000. We'll call it $44,000. But the difference in interest is a whopping $36,000 that you're paying. Now, while I do think that, hopefully we're going to be looking at refinances in the next 2 years or so, this is still a huge number and something that you should want to consider now, because $322 a month is essentially a car payment, right? A lot of people are leasing right now, especially because it's basically they're paying you to do it with the amount that rentals used cars are appreciating right now. It's crazy. We've never seen anything like that. But Kelly, if you don't mind going to the top, I just wanted to kind of quickly go over, this is obviously a rate savings. This is something we can offer. There are plenty of lenders out there that can offer good rates, so always shop, but this is just an extremely good product that we've been able to take advantage of this market with. And the biggest thing about it is you only have to have 10% down. You can go as low as 680 on the credit scores. But if you're buying a condo, there is no pricing adjustment. So typically in the market, if you were to buy a single family house, right, and let's just say the par rate today was 3.5%. If you're buying a single family house and Joe is getting a single family house for $350, his rate's going to be 3.5%. Then Cindy calls me and she finds a luxury condo in the same area for $350,000. Because it's a condo and those are the fastest to depreciate in, God forbid, a declining market, which I think Kelly just kind of spoke of, we're not looking for in this area. And I don't think it's something that we have to be worried about with the job growth and everything. Condos are typically the fastest to decline in value. So you always see what's called a loan level price adjustment. So Cindy's rate would be somewhere closer to a 3.99, whereas Joe had the 3.5% on a single family house. Just because on the secondary market, right, you'll get this, the servicers sell your loan. People are buying and selling loans. And as they do that, they want the safest investment for their money. So if they can't guarantee necessarily that if the markets decline, that their values stay the same, they want to at least be able to be backed with some interest, extra interest on that. So that's just kind of a cool thing that we have on this. If you're buying a condo, there is no loan level price adjustment. You would get the same rate that Joe got for a single family house for your condo, which is huge in this area. But Kelly, if you don't mind clicking on that green clock right below Prime Plus, I just want to kind of quickly go over this because a lot of people are saying to me, I'm really scared about rates right now. And then just click on the, yeah, you got it. You already extended, right? Perfect. a lot of people are saying, I want to wait till rates go down. I'm going to wait a year. I just don't feel comfortable paying this high of interest. And I completely get it. It's a lot to be concerned about. First of all, it's going to be the biggest purchase of your life. People that just got 3 and high 2 interest rates a couple of years ago, and you don't want to look like
Months
an idiot.
ago.
Yeah. Or it's tough to swallow, right? And so I wanted to give this as just kind of a bigger picture of what the cost of waiting would look like to you. So I think there's a better graph if you scroll a little bit farther down. And then again, this is on the same thing, a $500,000 purchase. There we go. So you can see the payment difference in waiting a year. And again, this is just through appreciation, right? Appreciation of the markets. That number can vary a lot, but what won't change is the loss in appreciation. So even just waiting 6 months, you're losing almost $2,000 in appreciation. And this is just an average for the United States. I think in this area, we can say that we are appreciating faster than others. Is that true, Kelly?
Yes.
Okay. So this is a pretty safe guess where we're saying in 1 year, that 1 year that you waited to save, and again, we showed right here on 500K purchase, we were saving over a full percent. The difference in payment is $344 a month. You're losing on $28,000 of appreciation and amortization. So
can we talk about appreciation for 1 second?
Yeah.
So I think now that I figured out how to share my screen, I can also show sort of the metrics. And so so if you kind of look at this, this is what I was talking about before, like where within our newsletter you can see the metrics. And so the sold price that I was talking about being down 7% is right here, right? And that is month over month. So that's from July to August, which is like we had one of the largest increases at that point, right? But the other thing is, if you look over here, the sold price is still up 11% year over year. So in order to basically like negate 2020 and 2021's growth, we would have to have significant deductions and reductions. And I think right now, our October, November market is typically slower than where we are in February, March, April, and so on. So like this, I think we've kind of gone back to our cyclical, seasonal markets, if you will, which COVID really messed it up for a while. Like our summer market of 2020 was absolutely insane because the spring was like sort of questionable. But I feel like we're kind of back into our seasonal market. And so that's one of the other reasons for this. But my point is, this is where you can basically find the metrics and kind of see what's happening. But we would have to lose another, 11% in order to even, basically go back on level with where we were last year. So just wanted to point that out.
Appreciate that. All right. Jumping back in, I won't take up too much of your time because I can talk about this for a while. But as you can see, just waiting 1 year, you're losing out on $28,000, the cost of waiting in 1 year. So while you're saying we want to wait because rates are high, let's say they drop a full percent, right? And in this example that I just gave you, the $500,000 with 10% down, we already said it's over a full percent difference in price, and the monthly savings is only $344. Now, while that's huge when you're looking at it as savings, when you're thinking about cost of waiting, $344 a month. Let's say rates go down a full percent. Not only are houses appreciating, right? So they're going to get more expensive next year. But even if they stay the same, and you're taking that 344 dividing by 12, that number is still way less than this $28,000.33, right? So real estate is all about building wealth, and Kelly is great with that. That's one of the first things when somebody's buying a new house that's already a homeowner. The first thing she says to me when she picks up the phone, I want you to run this with them keeping their house. I want them to be able to rent this house out because this is how you grow your wealth, right? There is a straight line on that path of people that have home ownership and the level of income or wealth that they have built over the years. And This graph will show you it all day. Waiting because of interest rates, if you can afford it, this is not something to wait on ever.
And also, the market is stabilized, right? It's already stabilized. It's already, buyers have the ability again to have home inspections and have appraisal contingencies and have financing contingencies. So if you've been waiting for that to happen, like that's already happened. The last couple contracts that we've ratified our buyers have been able to get all of those contingencies back into play. And, we're not way overpaying for properties anymore. You have the protection of an appraisal contingency. So it's also a good time. One of the ways that you can sort of hedge against this again is that because the prices over the last couple of months have been so high, you actually have the ability to take advantage of those appraised values, and maybe you get some seller subsidy. So if you need additional cash because you need some more cash for closing costs or whatever, now is a great time to be able to negotiate for those because you have the higher comps to justify being able to get the higher price. And you can use those closing costs or, that seller subsidy towards your closing costs. You can also use that towards buying down your rate too. So, that's definitely something that I'm talking to my buyers about as options to be able to play in this market, because, I think the interest rates are probably going to keep going up. I know, we were just talking, like the Fed meeting is tomorrow, but I think we both feel like the interest rate, the mortgage rate hike has probably already been built in for this week, hopefully, because the inflation rates were announced before. So, or last week, when was that? So I don't think that the mortgage rates are necessarily going to increase tomorrow, because it's not a direct correlation. And that's a lot of, when you hear, oh, the Fed rates are increasing, people immediately think mortgage rates are also increasing. And that's not really how it works. So that's another one of those things that I feel like is very misconstrued in our media.
100%.
So don't let that freak you out just because the Fed may raise the rate by 1% tomorrow or whatever. What is it? 1 point tomorrow.
Yeah.
Doesn't necessarily mean that mortgage rates are going to increase at the exact same rate. You could probably have explained that way better than me.
That's totally fine. No. Basically, when the Fed raises the rate, they're not raising necessarily mortgage rates, right? They're raising the Fed funds rate, which is what banks are borrowing from the Fed when they give out loans, right? So if I own a BB&T and I'm giving out people a bunch of home loans, right? I only have to have 10% of the money that I'm giving out to buyers in my bank. The rest I'm borrowing from the Fed at the Fed funds return rate, right? So when the Fed raises that rate, all that does is want banks to lend out a little bit less. It doesn't necessarily mean that interest rates are going to go higher. It just means that we're going to be more cautious with our money, which typically, as we do see, will lead us into a recession. But that is, if anything, in the long term, good for rates. But really quick, just jumping back into this, Fed funds rate and mortgage rates are not the same. They do correlate sometimes, but they are not the same, and they are not on the same trajectory. So just quick FYI on that. I know that's kind of a common misconception in our industry. So this will show you again. So 6 months, you're losing out $5,000. 1 year, you're losing out $28,000. Let's say we couldn't decide. We really wanted to save the extra 2 years to have, the full 20%. You lost out on $56,000 by waiting. Now, it's great that you want to put 20% down, but even now is the better time to, let's say, for instance, use this product that we have and put 10% down instead of the 20, right? Now, while your interest rate still might be in the fives, you can take that extra 10% and pay off some high balance credit cards, right, that you have with huge payments that you're paying interest. I mean, I looked it up today. The average credit card interest rate for people with a 740 credit score above is 16 to 18%. You pay off some of those, you're saving yourself $600 here, $400 here. That's a way to kind of combat the interest rates and have that monthly savings that you might not get in your mortgage rate, but have extra money coming in because you're only putting 10% down instead of the 20. Now you're probably paying an extra $200 now in mortgage insurance, but in the long term, that savings of paying that off is going to work for you. And if your mortgage lender isn't talking to you about things like this and how to attack it, you need to be talking to somebody who does. Aside from that, I will kind of wrap this up on my end really quick, and I'll let Kelly go.
Well, I was just going to point out, this is also based on the loss in property appreciation, right?
Yeah.
Like, this isn't even factoring in the amount of money that you're paying in rent and throwing out the window.
Bingo. Exactly. See? So this number is actually higher. Really quick, we talked on this. So there's a really awesome product we have out. I'm just going to go over it one more quick time. minimum 10% down. 680 is the minimum FICO. We do no loan level price adjustments for condo, which basically means your condo rate is the same as your single family rate. The best thing that's associated with this, it goes up to 1.5 million with only 10% down. But as long as you're under the Fannie Mae high balance, which is like what, 996, something like that right now.
And it's increasing, right?
Yeah. You can do what's called a value cert. So what we've invested millions of dollars into analytics to where we feel comfortable essentially establishing our own in-house appraisal waivers. So what that means is you apply with me, I get your pre-underwritten. Kelly says, hey, Mike, we're going to make an offer on this house. It's listed at 650. We want to put an offer at 675. I'm going to go ahead and run or submit for a value certificate at 685, just in case you have to go up a little bit. And they'll come back and say either approved or not approved. And if not, they'll tell us what we need to put down or at what value we would get it approved at. And let's say, okay, it's approved at 685. We get an actual certificate that we're going to send to Kelly that you can submit with your offer that says Embrace Home Loans guarantees this value. You will still have to get an appraisal done, but if that appraisal comes in short, you're not coming out of pocket that difference in cash. Whereas you, with a normal lender, you would have to do. Embrace is so confident in our analytics that we are saying if it comes back short, we will pay the difference out of pocket. So that's huge. I know we're the only ones offering that. A lot of people can do pre-underwriting. A lot of people can be competitive with rates, but what we strive to do is kind of be beyond, and that's kind of with the value cert and just our education. So if you guys are looking for more, 571-565-5119. I appreciate your time. Kelly, thank you so much for having me on. I'm going to let Kelly kind of take it from here. If you guys have any questions, definitely type it in the chat, but we are here for you guys.
All right, so that's really all that we have. We are going to chop this up and put it on our TikToks. If you are not already following us, I'm dating_houses. Michael is.
That's my mortgage guy.
That's my mortgage guy. So give us a follow on TikTok. I wanted to go live on there tonight too, but that was just, I had enough trouble with the technology. Nothing makes you feel like you're getting old when you can't figure shit out. But I can't curse on Facebook. Sorry.
Good show.
But all right. Thanks everybody for watching. Take care.
Thank you.
Peace.